In October 1907, the United States faced total financial collapse. Banks were failing across New York. Depositors lined up demanding their money. The stock market was crashing. Credit had frozen. The entire economy was on the verge of meltdown. The U.S. government had no central bank, no lender of last resort, no mechanism to stop the panic. So Treasury Secretary George Cortelyou took $25 million in government funds to New York and handed it to one man, J.P. Morgan. For 3 weeks, Morgan acted as America's central bank. He decided which banks would survive and which would fail. He forced other bankers to pledge their money. He organized bailouts. He locked financiers in his library until they agreed to his terms. One man, a private banker accountable to no one, controlled the fate of the American economy. The panic ended. Morgan was celebrated as a hero who saved the nation. But 6 years later, Morgan's allies met secretly on Jekyll Island and drafted the legislation creating the Federal Reserve. The crisis Morgan solved became the justification for a central bank that would serve the interests of bankers like Morgan for the next century. This is the story of how one man's power during a crisis was used to create a permanent system where private banks would control America's money supply. In 1907, the United States had no central bank. The Second Bank of the United States had been killed by Andrew Jackson in 1836, and no replacement had been created. Banks operated independently with minimal federal oversight. This created a fragile system. Banks held deposits but lent most of them out, keeping only small reserves. When depositors wanted their money, banks had to call in loans or sell assets. If many depositors demanded cash simultaneously, banks couldn't pay and would fail. Banking panics occurred regularly: 1873, 1884, 1893, and smaller panics in between. Each followed the same pattern. Some event would trigger fear. Depositors would rush to withdraw money. Banks would fail. Credit would freeze. The economy would crash. Eventually, confidence would return, and the system would recover. But there was no mechanism to stop panics once they started. The government had limited tools. Private banks could try to support each other, but they had no obligation to do so, and often protected themselves rather than helping competitors. The system worked during good times, but was vulnerable during stress. And by 1906, stress was building. Stock prices had risen sharply. Speculation was rampant. Credit was extended recklessly. The economy was overheated and due for a correction. All it needed was a trigger. The panic of 1907 began with a failed attempt to corner the copper market. Augustus Heinze and Charles Morse, two financiers, tried to manipulate copper prices by buying up shares of United Copper Company. Their plan was to create a short squeeze. They would buy shares and drive up the price, forcing short sellers to buy at high prices to cover their positions. Heinze and Morse would profit enormously. But the scheme failed. There were more shares available than they anticipated. The price of United Copper collapsed. Heinze and Morse faced massive losses, and their financial problems spread because they controlled several banks and trust companies. Trust companies were like banks, but with less regulation. They took deposits and made loans, but weren't subject to the same reserve requirements as national banks. By 1907, trust companies held about half of New York's deposits. When Heinze and Morse's scheme failed, depositors at their banks panicked. If these financiers had gambled recklessly with copper, what else had they done with depositors' money? Runs began on banks associated with Heinze and Morse. The Knickerbocker Trust Company became the focus. It was New York's third largest trust, and its president had been connected to the copper speculation. On October 22, 1907, depositors lined up outside Knickerbocker demanding their money. The trust couldn't pay. It had lent out most deposits. Within hours, it suspended operations. The failure of such a large institution triggered citywide panic. If Knickerbocker could fail, any trust or bank could fail. Depositors rushed to withdraw money from institutions across New York. The failure of Knickerbocker Trust sent shockwaves through New York's financial system. Other trust companies faced runs. Banks faced runs. Depositors wanted cash, but the institutions didn't have enough. The Trust Company of America, one of New York's largest trusts, was next. On October 23rd, depositors withdrew $8 million. The trust tried to meet demands, but was running out of money. If it failed, the panic would intensify. Banks that held accounts with failing trusts also came under pressure. If a bank's correspondent failed, the bank would lose its deposits and might fail itself. The contagion spread. Credit markets froze. Banks stopped lending to each other. Businesses couldn't get credit to pay workers or buy supplies. The stock market crashed as investors sold everything to raise cash. By late October, the panic threatened to destroy the entire financial system. Major banks were on the verge of failure. The New York Stock Exchange might have to close because members couldn't settle trades. Businesses were failing across the country. The government had no tools to stop this. The Treasury could deposit money in banks, but it didn't have enough to solve a systemic crisis. State regulators were powerless. The financial system was collapsing, and there was no institution capable of stopping it. Except one man, J.P. Morgan. J.P. Morgan was 70 years old in 1907, but still the most powerful banker in America. His bank, J.P. Morgan and Company, was the center of American finance. He had organized major corporate mergers, financed railroads, and had connections to European banks. When the panic began, Morgan was in Richmond attending an Episcopal convention. He rushed back to New York and set up headquarters in his library on 36th Street. For the next 3 weeks, Morgan would act as America's central bank. His first action was to save the Trust Company of America. If it failed, the panic would spiral out of control. Morgan assembled other bankers and demanded they pledge money to support the trust. Some resisted, but Morgan forced them to commit. He assigned teams of accountants to examine the trust's books overnight. They determined it was solvent if given liquidity support. Morgan organized an $8.25 million loan to keep it operating. The trust survived. Next, Morgan addressed the broader banking crisis. He organized meetings of New York's major bankers in his library. He would review which institutions were worth saving and force the others to contribute to bailouts. His method was simple. Lock the bankers in the library and don't let them leave until they agreed to his plan. On several occasions, Morgan literally locked the doors. Bankers who wanted to protect their own institutions were forced to pledge millions to save competitors. Secretary of the Treasury Cortelyou brought $25 million in government funds and gave it to Morgan to deploy. The U.S. Treasury was effectively subordinate to Morgan's decisions. Morgan also saved the New York Stock Exchange. Brokers couldn't meet their obligations and the exchange would have to close, which would trigger worse panic. Morgan organized a $25 million loan to keep the exchange operating. Morgan presented himself as saving the nation from catastrophe. And in some sense, he did. His intervention stopped the panic. The financial system stabilized, banks reopened, credit flowed again. The crisis ended. But Morgan didn't act purely out of patriotism. He and his allies profited significantly from the crisis. During the panic, Morgan's firm bought assets at fire sale prices. Stocks, bonds, and businesses that would have been expensive during normal times could be acquired cheaply during the crisis. Morgan positioned himself to profit from the recovery. Most significantly, Morgan used the crisis to acquire a major competitor. Tennessee Coal, Iron and Railroad Company, TC&I, was a significant steel producer competing with U.S. Steel, which Morgan controlled. TC&I's stock had been used as collateral for loans by the brokerage firm Moore & Schley. When stock prices collapsed, Moore & Schley faced failure. If it failed, it would trigger another wave of panic. Morgan proposed a solution. U.S. Steel would buy TC&I at a bargain price, taking it off Moore & Schley's books and preventing the firm's failure. This would save the financial system, but would also eliminate Morgan's competitor and strengthen U.S. Steel's monopoly. There was a problem. This might violate antitrust laws. U.S. Steel already controlled most American steel production. Acquiring TC&I would increase its dominance. Morgan dispatched 2 U.S. Steel executives to Washington to get approval from President Theodore Roosevelt. They arrived early in the morning and presented the deal as necessary to prevent financial collapse. Roosevelt, facing the choice between enforcing antitrust law and preventing panic, agreed not to prosecute. U.S. Steel acquired TC&I for a fraction of its value. Morgan eliminated a competitor under the guise of saving the economy. Once the panic ended, the public discussion shifted to preventing future crises. Morgan had saved the system, but the experience revealed dangerous dependence on one man. What if Morgan had been unable or unwilling to act? What if he had died during the crisis? Bankers and politicians agreed that America needed a permanent mechanism to prevent and manage financial panics. The 1907 crisis became the justification for creating a central bank. But bankers had specific ideas about what this central bank should look like. They wanted an institution they would control, that would serve their interests, and that would provide the liquidity they needed during crises without imposing regulations they didn't want. In 1908, Congress created the National Monetary Commission to study banking reform. Senator Nelson Aldrich, Morgan's ally and business partner, was appointed chairman. The commission would eventually lead to the creation of the Federal Reserve. In 1910, Aldrich and 6 other men, representing Morgan's interests and other major banks, met secretly on Jekyll Island to draft the Federal Reserve Act. This meeting, covered earlier in our series, designed a central bank that would serve banking interests. The Federal Reserve Act passed in 1913. It created a central banking system with regional banks coordinated by a board in Washington. But the system was designed to be banker-controlled, with private banks owning the regional Federal Reserve banks and influencing policy. Morgan didn't live to see it. He died in March 1913, months before the act passed. But his legacy was the system he had advocated, a central bank designed by bankers to serve bankers. The 1907 panic was the crisis that justified this creation. Morgan's intervention was held up as proof that such an institution was necessary. And the men who benefited from Morgan's power designed the replacement to serve their same interests. Who paid for the panic of 1907? Depositors who lost money when banks and trusts failed. Not everyone was saved. Smaller institutions often collapsed while Morgan's network received support. Workers who lost jobs as businesses failed during the credit freeze. The panic triggered a recession that lasted into 1908, with unemployment rising significantly. Shareholders in companies like TC&I who saw their firms acquired at fire sale prices. TC&I's value was much higher than what U.S. Steel paid, but the crisis allowed Morgan to buy it cheaply. Small businesses that couldn't get credit and failed. The panic disproportionately hurt those without connections to major banks, taxpayers who provided government funds that Morgan deployed. The $25 million from the Treasury was public money used to bail out private institutions. Who profited? J.P. Morgan and his allies, who bought assets at depressed prices and eliminated competitors. The TC&I acquisition alone was worth hundreds of millions. Banks that survived and faced less competition after smaller banks failed. The panic consolidated the industry. The financial elite who used the crisis to justify creating the Federal Reserve, an institution they would control and that would serve their interests. Future generations of bankers who benefited from a central bank that would bail them out of crises they created.